Welcome to September. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, it is the first trading day of September. Stocks and bonds retreat as Wall Street returns from a long weekend. The market's fate comes down to the next 14 trading sessions with the jobs report, a key inflation reading, and a Fed decision all on deck throughout. And plenty of news on the corporate front, too, from Elliott's $4 billion stake in Pepsi to a packed pipeline of IPOs. Dani, what are you watching?
Well, if September is the market test, we are failing it so far this morning. Look at what's happening to the Mag 7. Nvidia, Amazon, Meta, they're all leading the big cap stocks lower in the pre-market trading. It's building off not just last week's move, but also concerns of overstretched government budgets, inflation risks, the move in bonds you're pointing out, Matt, also weighing on this sector.
We're also watching, and it could be related, home building stocks after Treasury Secretary Scott Bessent said the Trump administration may declare a national housing emergency this fall. You see the home builders reacting negatively, and I kind of wonder, Dani, if this may worry the market because it means more fiscal spending, especially at a time when we might have to give the tariff money back.
I am totally there with you, Matt. It is just another thing, tick off the list of things to be worried about with long-term bond yields and higher deficits. And to that point, as you pointed out, we've returned from a long weekend to renewed anxiety in the bond market. Hello, September. Goodbye, summer. U.S. 30-year yields have climbed 5 basis points, while the U.K. 30-year yield has hit its highest since 1998. Valentin Marinoff of Credit Agricole thinks it's the vigilantes, not the data, driving the move in global long-end bonds.
I don't think data is driving the price action today. It's really the bond vigilantes in the developed markets that are driving the price action in the FX markets. We see the sell-off at the long end of the Japanese, the UK, even the European really bond markets intensifying.
Joining Matt and me now is Christine Aquino, Bloomberg's managing editor of Markets Live. Christine, what a painful start to the start of September. Summer is truly over, but there are so many things that could be driving this move. What can we pin it down to?
Well, Dani, I think, the bond vigilantes are definitely back, as Valentin mentioned earlier. And it's very interesting because it's playing out in such a way where you are seeing these twin declines in stocks and bonds, but that is primarily a question of what is going to win out at the end of the day, right? The benefit from potential Federal Reserve rate cuts as soon as this month on September 17th, or this idea of a longer risk of that fiscal situation playing out negatively for the bond market initially, which of course we know has a negative feedback loop back to stocks. And I feel like that is the tension between markets right now, that short-term hit from lower interest rates potentially, and then that long-term worry over the fiscal situation coming to head as September begins.
I don't know where I saw it, but tech stocks are seen as like very long duration assets. What is it? Eternal?
Like the infinite
yield?
maturity.
Infinite maturity.
That's right.
Okay.
Yeah. Or at least when bond yields are down, we call it that, and we say we like tech because of that.
Right.
That's right.
So is that why we see right now the big tech sell-off, or why else? Is it just market concentration risk, worry?
I'm sure it all plays together, Matt. I mean, of course, there is that question again, concentration risk, especially at a time when valuations not as high as before, but they are still near those astronomical heights. And then, of course, we got that reality check from Nvidia last week. But then also, I think the question of, in a low yield environment, they are great stocks as a whole. They are relatively inflation proof when you're looking for assets like that in the stock market. In an environment where there are potentially inflation risks lingering in the background, and then, add to that this idea that potential imminent rate cuts from the Fed could stoke further those inflation risks. Then it really comes into question, is it really a good inflation hedge at this point if you want to buy stocks when you have all these risks coming together and coming to fore as we go back to real markets, back to school this September?
All right, Christine, thanks so much for joining us. Christine Aquino, they are from the Bloomberg M Live team. Type MLIV Go, I should say, to follow along with what's going on in this market. There's a lot there on what's driving yields higher and how that's affecting stocks. Let's turn now to the tech sell-off with Bloomberg Tech co-host Ed Ludlow. Ed, as we were talking about, there's concentration risk. That's a concern. Right. There's the idea that these are longer yielding assets. What do you see across the tech sector driving us down this morning?
I see like the markets are split, right? You know, Nvidia's been under pressure and the main drag at the index level Friday, long weekend, intraday and this morning, largely on news flow post earnings. But most investors that we'd speak to would be sanguine and say, like, look, compared to 2000 dot-com bubble, even the financial crisis of 2008, the 5 largest Mag 7 names have just much infinitely stronger balance sheets and much greater earnings growth than any technology company showed at that time. You know, the data in the stories that we have on the terminal are very clear. In the period of earnings we just had at the S&P 500 level, you have 11% earnings growth from a year ago. For the biggest 5 Mag 7 names, you have 26% profit growth. And that's great. And, you know, there is nothing to dissuade many in the market that that will change. Thing is, it goes back to old-fashioned investing and having a diversified portfolio, because at the index level, if you have 30% of weighting in just those 7 names, that goes against everything that Dani Berger learned about investing. Isn't that right?
Thank you. I'm going to brush out my textbook, Ed, to figure this one out. But the textbooks might not help me with the politics of this moment, right? That's another theme that has been so dominant. And TSMC perhaps falling another victim to this, Ed. This morning we're learning that the U.S. pulled their waivers for China shipments of chip supplies. What's happening?
Okay, so breaking news story. This relates to TSMC's validated end user agreement, which allowed them to move gear to their mainland China facility in Yanjing. Basically, it's the same move that we saw from the United States last week, Friday, with Samsung and SK Hynix, where essentially any supplier associated with that facility in China has to get specific licenses in order to operate and pass on material to TSMC. The fundamental difference, but noting that TSMC's US ADRs are down significantly on this piece of news, is that TSMC has a very small footprint in mainland China, basically a single facility that's run since 2018. By comparison, Samsung and SK Hynix have a lot of chip manufacturing in mainland China. But going back to what we were just talking about on concentration risk, you know, the idea that the markets are sanguine on some names relative to others is that you also have Nvidia and the software names Microsoft, Alphabet, etc., Amazon. They are largely seen as being beneficiaries of US policy. TSMC is kind of caught in the middle, right, where America is trying to push them to do more in this nation while policing their activity outside of its borders.
Speaking of policing activity, we just have a breaking headline here that you can see on the bottom of the screen. Trump's LA troop deployment violated federal law. This according to a judge. We're going to talk later in the show with our Supreme Court reporter, Greg Stohr, about how the nation's highest court is letting these things slide. Let me get back, though, to tech, Ed, with you, because there's a story on the terminal about Tesla selling or getting only 600 orders for its launch in India, which is far fewer than had been anticipated. On the other hand, I don't know how much it matters if, as Elon Musk says, Optimus Prime is 80% of the future value of his company.
Okay, the reporting, Bloomberg reporting that around 600 orders, 600 for Tesla vehicles in India, which are priced at the entry level like $68,000, very high. Tesla had been very hopeful that they would hit a full government mandated allocation of almost 2,500. So that comes in well below that. Starting in September, our sources are saying they might ship 300 to 500 to India this year. But you're exactly right. We've got Master Plan Part 4 and accompanying post on X from Elon Musk that basically says in the future, 80% of value was the word he used, but let's say revenue or profit or whatever it is, comes from a humanoid robot, Optimus. So what does it matter in the here and now, tracking sales of consumer cars to specific markets? Well, you know, Tesla often has a very distant timeline for its vision and stuff, but you know, India, just as with smartphones, is a potential giant market. So that's why we track it so closely.
Ed, thank you very much for helping us track it. It's Ed Ludlow of Bloomberg Tech co-host. Matt, it might just be Optimus, not Optimus Prime, by the way.
Yes, that was.
I think that's a transformer.
Was my mistake. It's not Optimus Prime. Although the first one would be
Optimus Prime. It's
Yes.
a great point.
Yeah.
It should be called Optimus Prime. All right, let's get back to the market that is September. It is a tough month for stocks historically, and it's chock full of potential market-moving events. It includes jobs reports this Friday and a lot of jobs data like ADP and JOLTS heading into it. For more, we're joined by Michael McKee, Bloomberg's international economics and policy correspondent. Mike, it's back to school.
It's back to school. I was thinking Green Day this morning. Wake me up when September ends, because it's going to be a rough month. And we start with a lot of focus on the jobs report, of course. And it's not just the jobs report, it's the build up to the jobs report and where we go after that. We get the jobs report on Friday. Then next week, the BLS gives us a revision to a year ago's numbers that should show, at least according to Chris Waller's speech last night, that the economy created a lot fewer jobs over that time period, and that will have reverberations. September 11th, we get that CPI report, and then the Fed meeting on September 17th. After that, good luck with everybody looking for things from the economy. On Friday, right now, the forecast is for 75,000 jobs to be created, but we have a lot of numbers between now and then that will bear on that, maybe get people to change their views. 258,000 in revisions last month. Are we going to get something like that again? And the unemployment rate expected to tick up a little bit. If that happens, that's something that the Fed is keeping a close eye on.
I'm supposed to ask you about Stephen Myron's confirmation, but I'm sure it's in the bag and it doesn't really matter because the rest of the board is probably going to vote for a cut too. What I wonder about is the potential for tariff refunds. Have you thought about this? If a high court says the tariffs are illegal but gives them a stay until, the Supreme Court decides, is it possible that we have to give this money back at some point?
Oh, it's definitely possible if the Supreme Court, and this will go to the Supreme Court, rules that the tariffs were illegally applied, then they have to refund the money that they have collected, which will be very difficult because remember, the administration has made a big deal about how this is partially paid by foreigners, partially paid by importers, partially paid by consumers. How do you get your money back? Do you even know how much you paid? So that's going to be really difficult. They'll give the money back to the importers, basically. And then if Trump uses the other authorities he has to put tariffs on, then they'll start collecting those tariffs again. So it's money in one pocket and then out the other, it appears. But it is going to be very difficult for the government, particularly the longer this goes.
All right, it'll be very interesting stuff. Mike, we're going to continue talking to you about this for sure. And remember, Greg Storr coming on later to tell us that the Supreme Court has actually ruled in Trump's favor in about 18 of 21 emergency cases. So it's not likely to say that these tariffs are illegal either. Quick check on what's going on in futures. We do see equity indexes down pretty big to kick off what is historically a bad month. More than 1% a drop on the S&P futures, 1.5% on NASDAQ futures as big tech falls. And September, actually, if you look back, Dani, over the last 29 years, which is the most you can on the SEAG terminal function, you can see that September is absolutely the worst month and one of only 3 down months over that period.
It makes complete sense, right? Because you're lulled into a summer. People are away from their trading desks. They get back. And in this case, they say, oh my God, deficits are spiraling out of control, be it abroad or be it in the U.S. So let's freak out and let's treat the first day of September like we are today.
Yeah, and there's a lot of news today, as we've heard from Crystal C., and we're going to talk to her after the break. It is really a big deal for M&A Labor Day weekend. Coming up, we're going to talk about the reversal of one of those deals. Kraft Heinz is splitting up the company. Just the latest move in the refashioning of the food industry. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. First up, gambling stocks under pressure following a report that Crypto.com and Underdog are reportedly teaming up to launch sports prediction markets across 16 states. It's a very busy space. We are also watching the home builders this morning after Secretary Bessent said the Trump administration may declare a national housing emergency this fall. It can't come soon enough for these three, which are all down today. And shares of PepsiCo are rising in the pre-market after Elliott Investment said it has built a $4 billion stake in the company. Elliott says it sees a path for a price increase of more than 50% from today's level in Pepsi. Dani?
Let's get more on that story, that $4 billion stake from Elliott in Pepsi. For more, we're joined by Bloomberg Deals reporter Crystal C. Crystal, it's a big stake. $4 billion. Do we understand what Elliott actually wants to do to try to turn around Pepsi?
So Elliott this time put out a deck, so rarely we get to see what they really think, but this seems to be focused on a North America business. North America business, in terms of beverage, Pepsi's losing ground. In terms of food, which they own Lay's, potato chips, and they are also slowing in growth. So this is a story about undervalue, which is the most popular activist thesis. And this is Elliott coming in and say we should be able to help you with your value.
What do you think they're going to do that? Like, which levers do they have to pull to make Pepsi more valuable?
So we're kind of in early innings of this. The most popular things to do is probably to review the portfolio. With a conglomerate like that, it's always the thesis of bulk up versus breakup. In this scenario, you can totally see how they can pull like a Kellanova. You can see parts of the business are more under the influence of the Ozempic of the world, and you can potentially like carve out certain things. Or there could be more financial engineering, like the share buyback, like committing to some sort of, governance structure. So there are different things that they could do.
You bring up a point in consumer stocks, and it feels like every day we're learning about some new company that's deciding to split up. It was Keurig Dr. Pepper not that long ago. Today, it's Kraft Heinz. Is this a moment of stress? Is that why companies are looking not at roll-ups, but I guess rolling down?
So Kellogg was a great example of this. Kellogg was the one that started the whole trend. Like they broke it up into Kellanova and WK Kellogg, and both pieces have been sold off since. I think a lot of consumer companies are looking at this, having a soul-searching moment, thinking, is this actually better off? Like, are we going to unlock more value? And activists are seeing the exact same things. So whether it's Pepsi, whether it's any of the big conglomerates in any sector, will have to face this. Basically thesis.
Well, all of these companies, Pepsi, Kellogg's, Kraft Heinz, are under the stress of consumers wanting to eat healthier and GLP-1, weight loss drugs helping them choose fewer, Pepsis. The interesting thing, I think, in the Kraft Heinz story is that it's like a good bank, bad bank breakup. So the strong brands, the ones with the most growth, like mac and cheese, and Heinz ketchup, are going to be in one company, and the CEO isn't going to run that company. He's going to run the bad bank. He's going to run the Oscar Mayer wieners, right, and the Velveeta cheese. What's up with that?
You may want a more seasoned person to go with the brands that are less, growthy. But this is a good point. Like when you see the breakup of like high growth versus lower growth, any breakup, it's almost always a precursor to a potential M&A deal. So whether someone else comes in, the part that is higher growth, we call the flavor elevation business. It's like the condiments, the ketchup, the mustards. There are players in the chemical space, in the flavoring space, that could be a good buyer for that. So, if you foresee that happening, you may want to keep your CEO with the remaining business.
What do you have against Velveeta cheese?
I don't have anything against it. I don't think
Cheese is only
I've
good
ever,
if it's radioactive color.
I don't think I've ever eaten it, but that's the one you spray out of a can, right?
Yeah,
Is
they do
that?
that.
Yeah, one of the things.
Yeah, okay.
Great.
I don't know if I would. I guess I would try it. I'll try anything, but it's not something you want to add to your diet on a regular basis.
No, or feed
right?
your kids probably.
All right, Crystal, thank you very much. Busy weekend, I know it was for you, so I hope you can relax this week. Crystal C. from our M&A team. Coming up, RBC's Lori Calvasina says expectations for higher inflation may be helping to boost equity prices. She joins us to explain next. This is Open Interest.
Welcome to September, and we are kicking it off on a very cautious note. Higher bond yields putting pressure on stocks this morning. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, joins us now. Lori, it feels like it's picked up steam with September. To be fair, the long end has been going higher throughout the past month and some time. Why is it now that it seems that the pain is starting to trickle through to equities?
Look, I think that equity markets in August were, really focused on this interminable earnings season that just went on and on and on. Even last week, we had a number of different consumer companies reporting that kind of preoccupied people. But look, I think there's been a growing chorus, count me included, that has been warning about sort of the September scaries, the October angst. This is a week seasonally, kind of part of the year. We tend to see equity flows fade. For the past 5 years, September's been down. 3 of the past 5 years, October has been down. And you can even go back to earlier years in my career, right, when August has been pretty nasty. Yep. So look, I think the market, it was just sort of very laser focused on earnings. We've now finally gotten past that, and people are able to think a little bit longer term right now.
As we were talking about before, I look at the SEAG function on the Bloomberg terminal, and 29 years is the most you can look at. But if you look at that far back, the average is August and September are the worst months, and then February is the only other month that's down historically. I want to ask about the tariffs. This news from an appeals court, a federal appeals court, came Friday night, and it was like the conversation at every Labor Day barbecue that I went to, and I went to them all weekend
Good for
long.
you, Matt.
So everybody's talking about it, and does it have any reverberations, do you think, in equities?
So look, I think to the extent the bond market is reacting to that, the equities are reacting to that as well. I mean, a bond market spook will, kind of do us in equities every single time. But I'll tell you, I took kind of a more balanced view in the piece we put out this morning. Wrote it last night very quickly. But if you go back to Friday night, when I saw that news hit, I said, I'd almost forgotten that the court case was even going on because we've been so focused on things like earnings, the Fed, there's been all kinds of other news coming out of DC. And I wonder if that's part of it today, to be honest. My assumption all along has been this court process was going to take a long time to play out. Right. I did go back last night and sort of go through what companies had said about the last court decision that went against Trump on the tariffs. Found very, very little. Most of it was in late May after that international.
All right, Lori, let's dig more into that later because we have to go to the break right now. Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy, sticking around with us.
Moments away from the start of fall trading, and it doesn't look great this morning. We're looking at futures that are off more than 1% on the S&P, more than 1.5% on the NASDAQ as the big heavy tech stocks, Nvidia et al. Fall. You hear the opening bell, and you'll see it on the New York Stock Exchange. You got Bed Bath & Beyond ringing the bell. So psyched to still be in business. And not just that. The company is up 82%, or the stock is year to date. It's a meme stock. Obviously, they've lost almost all of their value over the past 5 years, like 90%. Bolsa Mexicana is ringing the bell down at the NASDAQ, which I always think is interesting when one exchange trades on another exchange, but it happens apparently a lot. Dani, what are you watching this morning?
Because just everyone wants to be in the U.S. That's the story, even other exchanges. But I am watching big cap tech, Matt. As you pointed out, a really painful start to the year for them. I should point out, if Nvidia holds this loss, it'll be the 4th consecutive day that it posts a loss, the longest losing streak since March. So the Mag 7 stocks leading the pre-market lower, builds on last week's tech sell-off. It also comes as concerns over stretched government budgets and inflation risk, Matt, as you've been pointing out, have been driving up bond yields globally.
Yeah, absolutely. And everybody from governments to corporates is moving to shorter dated securities. We'll talk about that throughout the program. We're also watching home building stocks after Treasury Secretary Scott Bessent said the Trump administration may declare a national housing emergency this fall. You see all these home builders down in a down market. The worst is luxury home builder Toll Brothers, down 1.6%. Now, amidst this sea of red, there were two really bullish calls out over the long weekend. Morgan Stanley's Mike Wilson expecting stocks to build on their 4-month winning streak, as Julian Emanuel of Evercore calls for the S&P 500 to rise another 20% by the end of next year. I believe that target is 7750, though they say that there are a lot of different potential scenarios. Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy, still with us here in the studio. And Lori, What's your take? I heard you on This Morning with Nathan Hager, and you were saying, like, we're going to see a lot of volatility, and you've been forecasting that for the second half, but we still could end up.
Yeah, look, I think in the short term, over the next few months, September, October have been weak seasonally. We've got valuations bumping up against recent ceilings. For the AI trade, I mean, S&P 500 cap-weighted, NASDAQ 100, those are the real anchors. And then also, if you sort of think about funds flow, they tend to be weak, and we're going to get a lot of tariff commentary for companies in conference season, right? So I think there's a lot of good reasons to be concerned about chop in the next few months. Looking longer term, we haven't done a 2026 target yet. We think it's way too early to do that until you really get a little bit closer to the end of this year. Things like my sentiment models just aren't going to give you a good signal right now. Some of our valuation modeling, and we run a bunch of different scenarios, I can get you to like 63, 6,400 on some more conservative scenarios. I can get you up to like 7,000, 7,200 for next year on more optimistic ones. So I don't feel bearish on next year, but I think it's too early to really have a high conviction call.
It's a very polite and subtle dig from Lori there.
No, I think it's fair, but I mean, Julian also lays out like 7 different scenarios, so they have that modeling as well.
But to that point, I mean, there have been plenty of people who have said, Lori, how can you possibly be bearish on this equity market as long as you're getting the hyperscalers spending the amount that they are, as long as you have the promise of AI and the productivity boost, how could you be bearish at all?
And look at today, we've got the NASDAQ futures, getting hit pretty hard in the pre-open. If you look to last week, we didn't sort of get comfort from the big AI names that reported. And what I noticed in the second half of August was that there was some AI skepticism that really emerged, that really seemed to kind of pull some, optimism out of the market, even though we were sort of creeping up to these new highs. And one of the things my colleague Amy Wu Silverman on the derivative side always points out is there is a lot of risk from concentration. So I think to the extent that you're seeing maybe a little bit of loss of faith, even if it's just temporary because valuations are so bad, on this AI trade, that can pinch.
I will say to our viewers, Nathan Hager's radio program from 5 a.m. to 6 a.m. is like indispensable for me. I listen every day on the way to work, and you're on it quite a bit. I learn something every time I listen, and today I learned that A, you used to be big into small caps, and B, through that, you started connecting inflation and higher stock prices. Explain that.
Yeah, so, last week of August, frankly, it's quiet. A lot of people are gone. We're sort of like looking at things we wish we had gotten to a little bit earlier in the summer. And as a small cap strategist from like the 07 through 2014 period, I remember one of the things someone told me when I first launched on that space, was kind of doing the work, is small caps are inflation bets, right? They were born in the late 70s, and you used to be able to do these really cool charts on inflation expectations against small cap performance. And it kind of broke down. But as I was sort of thinking about, why did markets just run so hot this
As you were
summer?
doing this research on your vacation.
Well, no, this was after the vacation, but like when I was, sort of, cleaning up and, kind of getting to things I wish I'd been able to do earlier. I went back and I looked at a whole bunch of charts on inflation versus stock market performance and small caps in particular. Stumbled on ISM prices paid, which we use a lot for sector work, but we actually found it's done a great job of explaining year over year both S&P and Russell 2000 performance. If you go back, a number of years. Now, the last couple of years, it's broken down. So, is this a really sticky relationship right now? I don't think so. But over time, I think these charts may have gone back to like 1996 or kind of 2000. I forget exactly which starting point it was. But it's been a really robust relationship. And we knew that, energy stocks were acting a little bit better. I'm getting an earful of about gold from my, commodity strategy team. And there were these little hints that...
We haven't brought up gold yet today.
This is probably the first time I've ever brought it up proactively on television, I can tell you that. But, it just sort of, there were hints that people were putting on inflation bets. And I said, I wonder if that's what's going on with small cap. And so we dug out those charts.
But last week when we talked, Lori, you really poured some cold water on the idea that rate cuts are going to mean that small caps can outperform that time. And I got to say, maybe we take a victory lap this morning because it's starting to play out. Small caps are getting punished basically more than everything in the market this morning.
The small cap futures were down even more than the NASDAQ 100 futures. And, if you look at the relative ratio, RTY against SPX, it peaked last Wednesday. If you sort of think about what's been going on, there's been a lot of optimism about rate cuts. And so that's what I've been hearing about, frankly, from my clients and my salespeople. What we pointed out, and I give credit to my rates team. I spent a lot of time with them last summer when the rate cutting cycle was kicking off. And they talked a lot about how this cycle that was starting up was similar to the mid-90s. Well, guess what? That is one time, that mid-cycle adjustment cutting cycle, one time we did not see small cap embark on a longer-term outperformance trade. There was no recession, and it made us realize that it's the economic cycle against the backdrop of those rate cuts that gives small caps the springboard. So you either need to break the economy and springboard it out, or you need a hot economy, things like really strong ISM manufacturing, job growth accelerating. We're just frankly not in an environment right now where we're getting those things. We'll see about ISM, but in general, we think economists are flagging growth concerns on top of inflation concerns, and that just doesn't seem like a recipe for small cap outperformance.
We've seen also, I think I was reading a note by Meredith Whitney over the weekend pointing out that consumers continue to spend a lot but aren't making enough. So they're digging into their savings right now. And we just had a slew of consumer earnings reports. What's your take on the U.S. consumer?
So, if you go back to week one of reporting season, the financials all come out and tell you everything is fine, that the spending levels are good and the delinquency's down and the stats all look great, and we're proud of the consumer for being value conscious. And then you actually listen to these consumer companies, and the consumer is not feeling good underneath the surface, and they're seeing it from a boots on the ground perspective. It's not a disaster, but the value consciousness has crept from the low income now into the middle income. So I'm seeing more and more companies talking about those stresses on middle income consumers. And even the high income consumers, these discount stores are talking about high income consumers trading down. So it seems to us there has been a response. It's slow. It's not, it's not kind of a bloodletting or anything like that, but we do see the consumer reacting to current conditions.
The consumer reacts, Lori, and Matt's been talking about the confusion of tariffs this morning. When you get court cases that maybe call into question whether these tariffs will last, what the income is this just another knock to corporate America trying to figure out how much and when to invest?
Well, that was kind of one of the punchlines of our note this morning was, we think uncertainty stays elevated. And on the one hand, you look at, okay, these tariffs getting knocked down in the court, maybe that gives you some hope. But we've been hearing from companies that they're seeing delays in decision making. And that has been part of the problem from the tariffs themselves, in addition to sort of the potential price impacts down the road. So even if it's for good reasons, right, are you encouraging corporations to just sort of sit on their hands and not do much, as opposed to kind of saying this is the operating environment we're in and moving on and proceeding? And I think that, to me, was kind of the biggest negative associated with what we heard on Friday.
Right, Lori, ending on a note of caution feels appropriate for today's markets. Thank you so much for joining us this morning. That's Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. All right, we are about 10 minutes into the market trading session, and it is a weaker day. You're looking at the majority of stocks easily moving down, 440 of this S&P 500 moving down. What is it that is dragging us down? It is the tech players. It's the same thing we saw on Friday. NVIDIA dragging this index down by 11 points. Then Apple, Amazon, Broadcom, all of them under a lot of stress. It is a lot of some of the corporate news that seems to be moving us higher. Pepsi on that Elliott news. And otherwise, you're going to see some of the more safe stocks moving us to the upside. And that's what you see in the sectors, too. Everything is in the red this morning, except for consumer staples, which is, barely in the green, 0.01%. And then it goes healthcare, and then it goes energy, and then real estate, some of the bond proxies. Again, this is kind of your textbook safety trade. Matt, at the bottom, it is infotech. It is what we've been discussing, down 1.7%. If it is the infinite maturity asset, what happens when long-term bond yields are moving higher across the globe and you get near 5% here in the U.S., maybe this is what we get more of. And again, that is tech leading us on the way down.
Yeah, I think another interesting thing is something that we tend to ignore on this program, and Lori Calvasina says she's never brought up on purpose, and that is gold, right? We see another record high on gold. It continues to march higher and higher right now, and it had been so flat from Liberation Day, but over the last 6 trading sessions, it just goes up, up, up.
And the other thing I think this underscores is, where in the world are your havens? Can you buy bonds right now with inflation, volatility? Gold maybe becomes the option, maybe the only option for you.
Yeah, I think it's a fascinating issue, and when you said Haven, it really brought that back to roost for me. Coming up, we're going to talk about Constellation shares after they cut guidance. Constellation seeing weak demand, particularly in high-end beer. Isn't that a haven? More next. This is Bloomberg Open Interest.
Welcome to September, welcome to the real markets, and welcome to this rude awakening. Stocks down across the board about 15 minutes into your equity session, led down by the Nasdaq, down 1 1/3% with those longer bond yields pressuring equities in a big way this morning. Let's now, though, get some of our top calls, some of the analyst action in focus this morning. First up, Deutsche Bank upgrading Frontier to buy, saying that the low-cost carrier is best positioned to benefit from rival Spirit's bankruptcy. Shares up 20.5% this morning. Next up, UBS has been upgrading Corning to buy, pointing to an AI-driven fiber growth exceeding expectations, those shares edging slightly higher. And finally, D.A. Davidson raising its price target on Alphabet. That goes to $190. They cite the company's competitive advantage in AI accelerator market, but everything AI, everything tech getting dragged down this morning, so those shares down 2%, Matt.
All right, thanks very much for that. Let's turn back to the consumer now. Shares of Constellation Brands falling as the beverage company cut its fiscal 2026 guidance, citing weak consumer demand. Joining us now is Ken Shea, senior beverage analyst for Bloomberg Intelligence. And Ken, this is a company that's been shifting around a lot of the brands that it owns, selling off some of its for example, wine brands, Mondavi and Mayomo, but it has Casa Noble, tequila, High West whiskey, and then a ton of beers that we know like Corona, Modelo, Pacifico, and so forth. What's the big problem at Constellation?
Yeah, hi, Matt. Well, the announcement today is really reflects the continued slowdown in their high-end beer business. The brands that you just mentioned, Corona, Modelo, Pacifico, they all trade at a premium or command a premium. And so with the malaise in consumer spending, or at least cautious consumer spending right now, that's clearly a reason behind that slump. But also, I would point out, Constellation has even said that about half of their beer sales are targeted toward the Hispanic community. And given the weakness in, home building and for other factors, that is a demographic that's been particularly weak as well. So those two factors are really behind today's miss. If I just might add real quick, there's more than just economic pressures as well. I think what the companies like Constellation and others seem to be understating is that there's lifestyle shifts going on. The GLP-1 drugs, the moderation in alcohol, these are all things that are weighing on alcoholic beverage more broadly as well.
Ken, do you think that's why we keep seeing a lot of corporate action, be it Kraft Heinz? Let's just talk about today. Kraft Heinz saying that it's going to split Pepsi, getting a $4 billion activist stake from Elliott management. How much of this is a consumer sector under pressure and in need of change?
Well, I think you're right on there. And also, Keurig Dr. Pepper last week said it's going to divest coffee as well. The common thread here is that the cold soft drink business is a really good business. And so that's why Keurig is trying to get out of coffee. With PepsiCo, and I would say Kraft probably, is that they're all feeling the pressure on the same things that Constellation is, in that the consumer's under pressure. They're economizing. They're buying less. They're deferring purchases. That we all know. But again, some of the structural issues of moderation, cutting back on sweet, salty snack, and the lifestyle dietary decisions are changing. And they're affecting different categories in different ways. And I think companies ought to be a little more forthcoming and candid in conceding that, like Brown-Forman did actually last week. They said, look, there's cyclical pressures, sure. We've had those in the past, but this is different. We have other factors going on. These may be longer lasting, and they're affecting all these companies.
All right, Ken, thank you very much. Those Pepsi shares up 3.4% this morning on that news. Ken Shea of Bloomberg Intelligence. Coming up, the U.S. IPO's market hot streak. Klarna is on deck to go public after its Wall Street debut was delayed earlier this year. Is it finally going to happen? We have the details for you coming up next. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on with stocks. To kick off the month of September, we're looking at big drops. So 1% down on the S&P 500. The same is true on the NASDAQ as you get some big, heavy tech stocks falling. I do want to point out that even as the dollar rises, investors are selling off longer-term debt. So here's the 10-year yield. You can see rising to 4.28. If you had the 30-year yield on here, you'd see it going to almost 5%. Nvidia, the heaviest stock in the world, down 1.2%. I should say the biggest stock in the world and the heaviest stock on the S&P 500 and on the NASDAQ. All of these Mag 7 names, Meta, Apple, Tesla, all down right now. And Tesla had some disappointing news in terms of orders out of India, where it debuted its vehicles to only 600 orders. You have gold as kind of the only thing rising in this market. I think Dani showed consumer staples were rising just a little bit, but gold stocks rising as the underlying commodity posts an all-new record high. 6 days in a row of gains, Dani.
Yeah, it's gold and it's dollar as your options of things that are doing kind of okay today. Maybe the IPO market will save us all, Matt. Klarna is looking to raise as much as $1.27 billion in its IPO. They're looking to offer shares for $35 to $37 a piece. It's expected to price on September 9th. Joining us for more is Anthony Hughes, who leads our equity capital markets team. Anthony, this is a company that had initially backed off of its IPO because of tariff stress. So how much of this is a test whether IPOs can come back into a market which, at least for today, still looks volatile?
Thanks. Yes, it's been a busy morning. We've actually had 5 IPOs launched this morning. Klarna was one of them, and perhaps the most high-profile one of those. But yes, having that many IPOs on the road at once, and they're all pricing next week, is going to be a test for the IPO market. But certainly, there's a lot of confidence driven from recent performances, and certainly the interesting theme with these IPOs we've seen launched today is there's a lot of what you could call fintech. There's a bit of crypto stuff as well, which has been a continuation of the themes we've seen recently, and most of these deals have been very successful. Maybe they haven't done as well as they did in the first few days as they did further along as they go along, but there's definitely a lot of enthusiasm. You would completely expect these IPOs to draw a very strong audience.
I look at a firm as a competitor to Klarna to judge how that may do. It's up 38% year to date. Is that a good thing for Klarna, or is a firm like taking too large a slice of the pie?
Yeah, well, I think a firm being a little bit depressed earlier in the year was one of the reasons that Klarna was delayed. So obviously a firm has had a pretty big run up more recently, and that's going to be the direct comp, certainly. That's going to be the company that people are going to be looking at to try and work out what's the appropriate valuation for Klarna. And basically a firm had a big bump there last week, and that was perfect timing for this IPO. So, you know, I mean, buy now, pay later is obviously a big part of Klarna's business, and this is a theme in financial services, which has been, not everyone's 100% a fan of, but it's been fairly durable, and the firm's been reasonably successful. Had some ups and downs along the way, but it's been sort of fairly successful over time.
Anthony, also, whenever I see a company like Klarna, it makes me think, okay, the IPO market is coming back, but maybe just for the U.S. You get one of these big UK tech companies that decides to list here instead of abroad. To what degree does this just cement the dominance of the U.S. market as the place that these international companies want to list?
Well, I think certainly companies with a tech flavour are looking to the US as probably a more logical place to list, simply because of the ability to get high valuations. Also, there's just a very well-established number of comps and to look at to assess the valuation, and also this is where a lot of money is as well. So, you know, certainly for a company that's certainly styling itself as it's a financial services company, but it's also a technology company, and you know, for tech companies, no doubt the US is a difficult place to be. To list.
All right, Anthony, great having you on the program to talk about these IPOs. We're going to be watching, obviously, very closely, and we often talk to people from the NYSE and the NASDAQ about this. They're obviously thrilled. Bloomberg's Anthony Hughes covers initial public offerings for us. Coming up in the next hour, we're going to talk with Paisley Nardini of Simplify Asset Management about the cracks that she sees in the markets. We're certainly seeing them today. Plus, we're going to talk about LNG and ammonia with Woodside Energy. The CEO, Meg O'Neill, joins us. And there's a lot to talk about in terms of yields as well. Rising yields continue to pressure stocks around the world.
Yep. And you also see, by the way, energy prices also adding to that. Higher energy prices, higher LNG prices. What does Woodside see going forward as we look at the NASDAQ leading losses with stocks off by 0.9%.
We are 30 minutes into the trading day, kicking off September with my second cup of tea. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, and you're going to need your caffeine this morning. A tough start to September, history playing out, bond yields higher, stocks lower.
We have economic news breaking as well right now, and it looks like S&P Global U.S. manufacturing PMIs are coming in a little bit lighter than we had anticipated, a little bit lighter than the previous reading. The same is true for ISM manufacturing, ISM prices paid. New orders look a little bit better than anticipated and a little bit better than they had last month. Let's bring in a pro here. Mike McKee joins us on set. He's Bloomberg's international economics and policy correspondent. Now that you've had 2.3 seconds to look through these numbers, Mike, what do you think?
I'm the pro from Dover, so I'll tell you, this is a little bit disappointing because there was an anticipation that things would get a little bit better in August, and we saw that with the S&P Global Manufacturing PMI about 15 minutes ago. It was up to 53 from 49 in July, rather. The ISM number comes in at 48.7 after 48 the month before, so that's an increase, but it's still under the 50 division between expansion and contraction, and it doesn't match the 49 that was expected. Prices paid is what everybody's been watching. That drops just a little bit to 63.7 from 64.8, but it does suggest there is still an inflation issue out there. Companies are having to pay more. The switch between 63.7 and 64.8 is significant enough, but not enough to tell you that problem is behind us. New orders, as Matt said, is the one bit of good news here, 51.4 from 47.1, and that might be what people were looking for, put it that way, in terms of some good news, some pickup in August. The production number, though, falls to 47.8 from 51.4, and employment at 43.8 is little changed from 43.4 last time. It still suggests contraction in employment, and that will go into some people's consideration of what we're going to get this Friday from the jobs report.
Can I pick up on that? Because Ian Ling and Abimo was talking about that this morning. The fact that this is going to be another jobs report, and maybe actually the first jobs report, where we have a BLS that's thrown into confusion about what the data shows us. Does that mean things like the employment component of this, that ADP, that JOLTS, that other factors gain in importance with how we're trying to judge this labor market?
Well, it's really what Wall Street wants to believe. Economists and statisticians don't have a lot of concern about the BLS numbers. It is a political thing that's been brought up by the president and his people who keep pounding away at it, and that's what they're trying to do, is get people to think there's something wrong with the numbers. Although if the numbers come in strong, I bet there's a miraculous healing process that happens. But you do look at everybody always looks at the ISM numbers and at the ADP numbers and the jobless claims numbers and the regional Fed numbers because they're trying to get an input into what the jobs report might show. So that's not going to change, but there might be a little more weight on some of these.
All right, Mike, thanks very much. Bloomberg's Michael McKee, a busy week ahead of him. Let's bring in right now Paisley Nardini, Simplify Asset Management Head of Multi-Asset Solutions, remaining optimistic heading into September, writing, quote, "There are cracks in the road, but no sinkholes. Corporations remain resilient, and if employment doesn't crater, the consumer can continue to hum along." Paisley joins us right now with a look at all that's going on today. Paisley, it looks like at least a depressing start to September. What do you make of higher yields weighing on stocks globally?
Good morning. Thanks for having me. September is actually one of my favorite months, albeit not generally a strong month for the markets. And I think today's an example of that already coming to life. We're coming into September. Valuations are pretty frothy. We have equities really finishing August at all-time highs. We have gold hitting an all-time high. And I think ISM manufacturing data is one proof point. I think we have a couple more data prints in the next 2 weeks here that'll lead us into that FOMC meeting. But I think September is a wonderful time of the year to start thinking about diversification in the portfolio, starting to think about some potential hedges, because seasonally speaking, September's been a weak month for the markets.
By the way, that ISM data coming in weaker, seemingly to help risk assets, at least on the margins this morning, maybe confirming some of the cuts. Paisley, you say it's time to diversify, but diversify into what? At a time when government bonds look more volatile because of volatile inflation, when things like big cap tech that seemingly are safe for getting questioned on their AI profile. What is the hedge right now?
Yeah, I think it's important to take a bigger picture as well. Many of our portfolios are not just stocks, they're not just bonds. They're a multi-asset portfolio. And that multi-asset construction of stocks and bonds together was really predicated on low correlation and low volatility of bonds relative to stocks. And I think the last couple of years has been a good proof point that we might need more in that portfolio. So some examples of ways to diversify beyond your stock bond portfolio is seeking ways that are not really tied to economic risk. They're looking at ways to go rather than just long the markets, long and short. Way we think about that is trend following. It's had a bit of a rocky start to 2025, but we do think that's a strong diversifier given its low and even no correlation to stocks bonds. Commodity long short applications also strong. And then of course, gold. Gold has been making headlines over the last couple days as it hits all-time highs. And we think there's continued tailwinds in that asset class to diversify versus stocks bonds.
I wonder about diversifying into high yield, which is something that you mentioned in your notes. And I just have trouble getting my head around why spreads are so tight. And if there's an economic downturn, isn't that a problem? We already see bankruptcies, at companies that aren't in the debt markets soaring.
Yeah, great point. I would say credit spreads at all-time tights is kind of similar to what we're seeing. Equity valuations at all-time high. Credit spreads are at very tight historical levels. The VIX, a measure of volatility or implied volatility in equity markets, also quite low. So all of these signals and indicators are suggesting that really everything's calm on the surface, which comes back to my initial point, is we do believe there are cracks below that surface. And so asset classes like high yield credit or high yield bonds, we think can be attractive if you are seeking higher levels of income, but doing so in a prudent way. So really thinking about active management across asset classes, but especially in some of those more credit sensitive areas, as well as incorporating additional hedges, thinking about if spreads do widen from here, which they are likely to move wider at some point rather than tighter. How do we think about hedging a portfolio, and how do we think about protecting those higher levels of distribution that our clients are requiring?
Paisley, I love this conversation because it is this feeling of why aren't markets pricing in more? And what you're pointing to is we might get to a point where markets are doing that and you need safety. But on that point, Paul Krugman wrote this really interesting essay over the weekend, basically saying that markets, even if they see risk coming, they're very bad at pricing them in because the crowd doesn't price it in. And you don't want to stick your neck out to be the first to do it. So to what degree are we in a game of chicken and just waiting to see what and where markets blink first?
We do think there's going to be quite a bit of volatility over the next couple weeks because of the employment data, because of the inflation data coming in. All of this is really going to drive whether the Fed goes through with that expected 25 basis point rate cut. We think, or I personally think, they're likely to do so. I don't think they want to rock the boat too much. And to your point, markets have priced this in. So how can we look through the noise? I think if we were to go back a few weeks, things felt pretty strong. Corporate earnings have been extremely resilient, which has supported equity markets. And so now it's coming down to can the consumer really bear layoffs, thinking about higher inflation. And ultimately, that expected rate cut should support equity markets into the back half and really the fourth quarter of this year. So even though a rate cut wouldn't assume that there's starting to be cracks in the system, that kind of easing and that monetary support should be that tailwind, in our opinion, to drive markets higher in the fourth quarter of this year.
By the way, if you have a long-term outlook, Paisley, if you're willing to be invested for the next 10 or 20 years, do you just hold your nose and buy the Mag 7s even at these valuations? I mean, I'm looking at NVIDIA right now. The estimated PE is 38. That's not incredibly high, right? Costco is 52.
Yeah, I would say long-term bull here. So I always think markets over the long term, especially those horizons that you shared, 5, 10, even 20 years, markets are likely to go higher. I do think we still, as investors, have a bit of a recency bias and thinking about that concentration and where earnings growth is coming from, which is the Mag 7. I'm a big fan of diversification, and I think 2025 has already proven out that whether it's international stocks, whether it's some more kind of niche parts of the U.S. equity market, can play a very vital role in the long-term capital appreciation goals that many investors have through equity. So long-term bull, I do think markets have already started to broaden out. And I think if we can incorporate that in our portfolio construction to have diversified sources of risk and return, we're probably going to be better off in that long-term horizon that you mentioned.
There's one issue or one place in this market that's been struggling to broaden out to. Kevin Gordon of Charles Schwab underscores this. For the Russell 2000, it's been 955 days since there was last a record high. That means the streak is now longer than the one after the financial crisis and the longest since 2004. Paisley, what, if anything, revives the small caps?
Couple thoughts there. I would say a rate cut in September and even additional rate cuts priced into the market could be a catalyst to support, of course, a lot of the smaller cap companies that are more exposed to external funding sources are going to benefit from overall lower rates. And I also think that the theme of AI, as that trickles down from mega cap stocks into the small and mid parts of the economic market, those companies can start to benefit from some of this technology and reduce bottom lines and increase kind of their margins overall. So further rate cuts and AI trickle down, I think, the two themes that will be a catalyst or tailwind for small cap over the next 12 to 24 months.
Paisley, wonderful to get your thoughts this morning. Thank you so much for joining us. Paisley Nardini, Simplify Asset Management Head of Multi-Asset Solutions. Let's get a look at some of the single stocks moving this hour with equities falling. Bloomberg Equities reporter has it. Hey, Alex, what you looking at?
Hey, Dani. Elon Musk is de-emphasizing Tesla's car business like never before. Instead, he's shifting focus to humanoid robots, a technology that is still in its early stages and ways away from generating any kind of revenue for Tesla. The CEO said that the company will derive about 80% of its value from Optimus, the robot initiative. Musk predicted that Tesla may be ready to start delivering its robots to other companies in the second half of 2026. He described this as a very rough guess. He first rolled out the initiative 4 years ago. The stock is down about 0.8% right now and down 17% year to date. And also watch home building stocks today after Treasury Secretary Scott Bessent said that the Trump administration is considering declaring a national housing emergency this fall. Bessent said that housing affordability would be a key point of Republicans' 2026 midterm election platform. The administration is studying ways to standardize local building and decrease closing costs to address housing affordability. Take a look at stocks like D.R. Horton, Lennar, Installed Building Products, and others. And finally, Frontier Group Holdings is soaring today after getting an upgrade from Deutsche Bank to buy from hold. It said that the company is best positioned to benefit from Spirit's bankruptcy. Analyst Michael Linenberg says 35% of Frontier's network overlaps with Spirit for the September quarter. Deutsche Bank's price target of $8 implies a 63% increase from Friday's close, guys.
All right, Alex, thanks very much. Alex Semenova there looking at some of the stocks on the move on this. Should be Monday. It's actually Tuesday. Coming up, President Trump continues to push legal bounds, and critics argue it has created a law-free zone for his administration. We'll head to Washington next to talk about what the Supreme Court is allowing. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. Crypto.com and Underdog are teaming up to launch a sports prediction market exchange. That's sports betting. The service will be available on Underdog's app and let users buy and sell contracts based on outcomes in major U.S. sporting events. Next up, activist investor Elliott Investment Management building a $4 billion stake in PepsiCo. The news sending Pepsi shares to their highest intraday level since March 10th. And finally, Kraft Heinz planning to split into two separate companies. One will include Heinz ketchup and other iconic condiments, if condiments can be iconic. The second firm will include slower growing grocery products like Oscar Mayer wieners. Over the past 7 months, President Trump has pushed the limits of executive power, and the Supreme Court has often gone along with it. On more than a dozen occasions, the justices have lifted lower court injunctions that found the administration likely acted illegally, and often the Supreme Court doesn't even explain it. Bloomberg Supreme Court reporter Greg Storr argues this pattern is testing the very foundations of America's rule of law, and he joins us now. So, Greg, it's interesting. In all but 3 of 21 emergency cases decided since January, the Supreme Court has decided in favor of the Trump administration, which the Trump administration considers a vindication of its policies. How does it look to legal scholars?
Well, some legal scholars are pretty concerned, and these are all cases where the question is, what do we do until there's a final ruling in this case? What happens in the interim? And the court's practice has been pretty consistently at this point to sort of err on the side of the president, to say we are more worried that the president wants to do something and is not able to do that than we are that there might be a legal violation or that somebody's rights might be violated. Not in every case, but in the lion's share, certainly.
Greg, it takes on new importance on a day like today when there are 2 things, monumental things, making their way through the courts. That is tariffs and the attempted firing of Lisa Cook. It is a market that expects that tariffs will be put on, but a market that does not expect Trump to be allowed to get rid of Lisa Cook. Is that a fair view? Is the court going to be treating things like the Federal Reserve different than these other court decisions?
Yeah, well, there are two very different sets of legal issues there. I wouldn't want to hazard a prediction, but I'll offer a few thoughts. With regard to Lisa Cook, we did see a few months ago that the Supreme Court expressed real concern about the Fed's independence, that when it was letting Trump fire the heads of other agencies, that it went out of its way to carve out an exception for the Federal Reserve. Now, that was not a case involving for cause, no allegation there that anybody had done something wrong, and that's, of course, is what the Lisa Cook case is about. So the outcome of that may be very different. In terms of the tariffs, obviously a huge ruling on Friday from this federal appeals court. And, that really goes to questions of presidential power that are pretty similar to questions that we saw with Joe Biden when he was trying to do things like forgiving student loans and imposing shot mandates or testing mandates during COVID for workers. So that's going to be a huge test of whether the court sees this as different from those Biden-era fights.
Greg, I don't study the Supreme Court, but I love to read your reporting. And I've always heard of, for example, Justice Roberts as being very concerned with the institution and the legacy of the Supreme Court. What are the other justices that seem to be throwing caution to the wind when it comes to the rule of law and the Constitution, thinking about what their legacies are going to be?
Well, it's always hard to say too much because a lot of these rulings we're talking about, as you said at the top, Bat, don't give a whole lot of or sometimes any explanation. So we're speculating when we start talking about what they're thinking. There are on this court some very conservative justices who believe very strongly in things like a strong presidency and that the president ought to have the ability to take certain steps, particularly in the national security area. And, they see themselves as righting a lot of wrongs that previous courts have done. John Roberts, for a while, was sort of in the middle of this court, but at this point, he's no longer in control. Or at least not in the way he used to be. He's not the justice we think of as the median justice anymore. He is potentially the 6th conservative rather than the 5th conservative. So he has less control when those other justices are more interested in pushing the law in a certain direction more quickly.
What does the trajectory of this mean, Greg? Because these are not just court decisions that impact the next 4 years. They will impact governments beyond that. So what does it mean for future presidents coming in and how it sets them up to have control over this government?
Yeah, that is a great question. I don't have a clear answer for it because we did see in the Biden years that the court was, more skeptical of what that president was going to do. You can have a long debate about whether that was because they didn't like the president's policies or if they were for neutral rulings. Certainly, you can say in a very broad sense, this court has, over the past 8 months or so, expanded presidential power, let the president do things that we might have thought previously a president couldn't do. And certainly some of those things are going to help out future presidents, whether they're Democratic or Republicans. But whether the court has changed it for every president going forward, hard to say.
When you talk about conservatives, and I often hear that phrase used in a way that confuses me, I would imagine that they're for free trade, for example, or that they value the independence of the Federal Reserve. But does these conservatives, preference for stronger executive power outweigh those things that are traditionally considered conservative?
Yeah, that's a good question. At least when I say conservative, because I think about justices, I think about things about like how they interpret the Constitution and how they focus on the meaning of the words when they were adopted. And as a judicial conservative, one does tend to favor executive power. That's sort of part of that. They see a strong presidency. And, that probably in most cases outweighs whatever policy interests they may have. If you ask any Supreme Court justice, they will say, my views on free trade are irrelevant. I'm just applying the law. And again, we can have a debate as to, whether that's what is really going on, whether those instincts will, policy instincts might actually influence the ruling.
Greg, this story isn't going anywhere. Thank you so much for joining us. A fantastic column. Recommend everyone go read it. That is Bloomberg's Greg Stohr in Washington. Still ahead, more on the politics. Lawmakers return from their summer break. We're going to take a look at the congressional agenda as another government shutdown looms. This is Bloomberg.
Let's get a check on the stock market right now. I'm using the move function on the Bloomberg terminal, and it is the most dynamic way to look at what's going on. You can see we have almost 400 losers for 100 winners, so very bad breath. The market started out down, recovered a little bit, but it's tough to recover when you have every single Mag 7 name down on the day, and they're all pulling down the index here. There are some gainers. You can see PepsiCo, for example, up 2.5% there on hopes that Elliott's bet it'll rise 50% from the level before they invested $4 billion is going to save the day. In terms of the industry groups, all of them now are down. When Dani was looking at this earlier, consumer staples was treading water, but it's now sunk. Healthcare, the biggest loser, the least losing sector, followed by energy, IT, and industrials, the biggest losers here. Coming up, energy is back in focus this year thanks to AI. We're going to talk to the CEO of Woodside Energy next. This is Bloomberg.
Australia's biggest producer of fuel is expanding its presence in the U.S. Woodside Energy currently has projects under development in Texas and Louisiana. According to Woodside, its Louisiana project is the single largest direct foreign investment in the state's history. I'm pleased to say that joining us now is the company's U.S. growth strategy is Meg O'Neill, Woodside Energy CEO. Meg, thanks for coming into the studio this morning.
Thank you for having me.
So look, this huge investment into the U.S. at a time when the political environment is one, where it is the Trump administration trying to bring more money in. I'd love to know whether you had any conversations with the administration and how they're feeling about this big LNG factory getting up and going in Louisiana.
Well, look, I think it's important to start with the fundamentals. So when we think about where we're going to invest in the energy sector, we start with the question of where is there oil and gas? And you look around the world and you'd say nowhere competes with the U.S. in terms of the oil and gas production capacity today and the potential for future development. The second question we ask ourselves then is, when you look at the fiscal terms and the regulatory environment, where can we invest in a manner that's profitable and generates value for our shareholders? And again, the U.S. stacks up incredibly high on that front. So you roll forward, and we made the decision to acquire this asset actually last year, pre-election, recognizing those fundamentals were in place. The thing that's changed with the new administration is their incredibly deep desire to help expedite investment in U.S. energy. And it's not a question of, speaking at high levels about we're here to remove barriers. It's tell me exactly what regulations are a problem, tell me exactly what you need, and we will help you. So that intent to try to accelerate investment in U.S. energy really is phenomenal.
Yeah, you've got fantastic tax treatments from the one big beautiful bill to help in this kind of thing. But you've also got tariffs, right? And you have to be bringing in like heat exchangers and compressors and cryogenic tanks and lifting arms and all this really cool stuff for an LNG terminal that's made of steel. How much did tariffs push the cost of this higher when you were looking at it?
Look, a couple of factors have worked in our favor. First off, the site that we're working on is designated a foreign trade zone. So the authorization that accompanied that designation is that we can bring things in without tariffs.
Oh,
now
that's a bonus.
Now, there's a lot of dynamism in the tariff landscape, so we are working closely with administration to get clarification on that. But if you step back, the $17.5 billion that we're going to spend, about 75% of it actually is labor. So of the, call it 25% or 30% that's materials, about half of it is U.S. sourced, about half of it is foreign sourced. So when we asked ourselves, and we took FID in April, so this was right around the time the tariff activity was getting started, we said, look, we're comfortable with the level of tariff risk that we have. We're comfortable that we can manage that. We believe the foreign trade zone designation will give us the relief that we want, but we'll continue to work closely with the administration to make sure that the investments in U.S. LNG are as competitive as they can be.
Well, not only is your equipment really specialized, but to the point of what you're talking about, the labor force you need is incredibly specialized too. And construction is one of these areas that is dominated by foreign-born workers. So how much does immigration curtailing make it more difficult to find the people in the Gulf area that are necessary to do these projects?
Well, one of the great advantages we have with Louisiana LNG is our contract is with Bechtel. So we have a lump sum turnkey contract with Bechtel. They are a powerhouse in the Gulf Coast construction world. They have a Rolodex of labor that's thousands of people long.
So, well, not now. Now it's 500s of people long, right?
Look, the reality is to work at a U.S. major infrastructure project, you have to have the permanent right to work. So Bechtel is accountable for finding the labor, and they thus far are having no issues. In fact, I'm pleased to say we're ramping up to about 900 workers at site on our pathway to a couple thousand workers at the peak of construction.
Overnight, Gazprom and China, Beijing, advanced their Power of Siberia 2 pipeline deal. That's what they're calling it, Power of Siberia 2. That brings a ton of fuel at lower than European prices. Do you see that challenging LNG demand, the outlook for China and LNG demand?
Yeah, not particularly. So if you looked over the last few years, China has signed up to a number of long-term LNG offtake agreements from U.S. projects. With the tariff dispute, there's been less U.S. LNG actually going to China. But China's always had a strategy when it comes to energy that's diversification. So they've got coal, they've got nuclear, they've got renewables, and they've got natural gas. When we look at the global LNG demand growth forecasts, yes, China will contribute, but Japan, Korea, traditional markets continue to be very important. And then we've got markets that are hungry for LNG but are very price sensitive. So places like India, Pakistan, Bangladesh. Southeast Asia is increasingly becoming an LNG importer. So even with this new agreement between Russia and China, I don't carry any significant concerns around what it means for long-term LNG demand. LNG offers the ability of consuming nations to source from a variety of locations. And others will be watching the success that Japan and Korea and China have had in diversification. So I'm quite comfortable that we will be able to find attractive pricing for our LNG.
On the demand side of things, there's this real question about what AI is doing and the demand for energy there, and whether it's crowding out other things and just in general pushing up the price of energy. How do you see things evolving with increasingly these hyperscalers sucking up more and more energy needs?
Yeah, it's been really fascinating, actually. So when we were talking to companies in the tech sector 5 years ago, they were saying, we're not really interested in talking to you. We just want to talk about green energy. We just want to talk about solar and wind and maybe green hydrogen. And now they're saying, we'll talk to you about anything. So the world has moved a tremendous amount in the last 5 years with AI underpinning it. And the U.S. energy strategy really is recognizing that for the U.S. to win the AI arms race, it needs to win the energy race. So look, it's anything that is positive for energy demand is good for our business. You know, when we think about our long-term investment horizon, the investment decisions we make pay out over 10, 20, 30 years. And it's very clear that AI is going to be a significant contributor to demand in the long run.
When we were reading about your company in preparation, we saw that you not only are a powerhouse in LNG, but also in ammonia. And I had no idea how ammonia plays into the energy infrastructure. Explain it to us.
Yeah, so we recently, last year, we acquired a project in Beaumont, Texas. We call it Beaumont New Ammonia. It's to produce low-carbon ammonia targeting the energy market. So I think most folks would think of ammonia as traditionally used in the fertilizer industry, which it has been for decades, of course. But when we look at the question of how is the world going to tackle emissions reduction and tackle climate change, you can blend ammonia into a coal-fired power station. You get the same power output with reduced emissions. When you look at maritime transport, so again, this is a hard to decarbonize sector. The maritime industry has been working on what are the alternative fuels. And ammonia is an alternative. You can adapt a ship's engine and you can adapt a ship's infrastructure to be powered by ammonia. So we made the acquisition. The project uses carbon capture and sequestration. So that reduces the carbon intensity of the ammonia that we will produce, and we'll be marketing it to customers in Europe and Asia.
All right, fascinating stuff. Meg, really appreciate you joining us this morning. Meg O'Neill there, the CEO of Woodside Energy. Let's get a check now on what's going on in these markets. Just about an hour into the session, a little more than that. We are looking at red arrows still across the board. Not as bad as we did at the open, but we're still seeing 4 losers for every 1 winner on the S&P 500, and the index is down 0.9%. NASDAQ losing a little bit more as we see yields rising. The 10-year 4.26 and the 30-year getting closer to 5.
Some serious pressure this morning, but let's look at some of the individual stocks that are on the move at this hour with Bloomberg Equities reporter Alex Semenova. Hey, Alex.
Hey, Dani. Constellation Brands is plunging today after the alcohol beverage maker cut its guidance, citing weakening consumer demand. Its president and CEO said that high-end beer buy rates are decelerating sequentially, both in trip frequency and in spending per trip. Shares are down about 7% right now. The stock is down about 27% year to date. Other beverage makers are also falling in sympathy. Elsewhere, activist investor Elliott Management built a stake of about $4 billion in Pepsi, with plans to call for changes at the struggling beverage maker. The position makes it one of Pepsi's largest investors. The activist said Tuesday in a letter to Pepsi's board of directors. The activist laid out its plan for how Pepsi can regain market share and improve its financial performance. Its market value has declined more than 25% in a little bit over 2 years as it struggles with competition from and changing consumer preferences. Elliott's stake was previously reported by the Wall Street Journal. And finally, Kraft Heinz plans to split into 2 separate companies, undoing a mega deal ushered in about a decade ago. One company will include Heinz ketchup and other condiments and boxed meals. The second firm will include slower-growing grocery products such as Oscar Mayer and Lunchables. The split will occur through a tax-free spin-off, allowing management to better focus on growing each side of the business. Kraft's chairman said that the current structure made it difficult to allocate capital to those products. The stock is down about 21% over the last 12 months. Guys.
All right, Alex, thanks very much. Alex Semenova there looking at some of the stocks moving at this hour. Coming up, anxiety in the bond market. Global yields rise as investors return from a long weekend to, as some say, end summer and start work again. This is Bloomberg Open Interest.
Welcome to September. Welcome to the return of real markets. And a rude awakening you are getting as you sit back into your trading desk just about over an hour into your trading day. S&P 500 down 1%. Matt, it is tech that is leading losses because of what we're seeing in bonds. It's not just the U.S., it is globally in the UK, in France, in Germany. It is multi-decade highs for the 30-year yield that's pressuring U.S. markets too.
Yeah, let's talk about what's going on in the bond market right now. What's driving that? Bloomberg's macro strategist Simon White joins us now out of London. And Simon, you have a great piece this morning on the U.S. Treasury attempting to tamp down volatility and provide liquidity. That could result in longer term a big a resurgence in long end rates, but we're seeing already globally long end rates start to pop higher.
Yeah, I mean, this is something that has been, brewing for a while, if you like French yields and UK yields have been creeping higher, but it's really not just about a French or a UK problem. I mean, they are kind of vying at the moment to see who's going to be the first for the bond market to repudiate their debt. But, overall, we just have a situation since the pandemic, really, where most developed market countries have just been running very large fiscal deficits. And if you look at non-recessionary fiscal deficits, it's really kind of unprecedented, right? You have these pro-cyclical fiscal expansions going on. And that's been happening, as I say, for the last few years. And we're getting to the point now where the bond market is becoming quite wary about what that actually means. And of course, when the bond market gets wary, that means rates have to go higher.
Rates have to go higher, Simon, but we've seen higher rates, not in the 10-year yield, which is interesting in its own right than the U.S. That's actually lower on the year, but we have seen long end drift higher, and it's been an equity market that at the same time has hit new highs. Today really seems to be one of the first days that it's caving into some of the pressure from the bond market. Simon, what tends to be the threshold that the bond market needs to go over to actually get some sort of reaction out of risk assets?
If I knew that, I'd be very, very rich. Yeah, I mean, at some point, just things kind of become too much to bear. I mean, perhaps beginning of the month is playing a part here. It's, of course, well telegraphed that September is a terrible month on average for stock markets. So it could just be a collusion of things. The yields are inching up higher, plus the fact that, as I say, you have September. But, you have the US market's been led by tech stocks. Tech stocks essentially have an extremely high duration. You have all these distant cash flows, and especially as mainly the AI companies are spending so much money, so much capex, and that really puts off when investors are likely to get paid. So that combination of things, very high duration assets such as tech stocks, meeting these very high yields or rising yields, that's really kind of a bad combination for those sort of assets. And really, you mentioned the longer end there, like it's the 10-year, of course, people are fixated on, but the 30-year in most markets is having a worse time, and that's really because the 10-year, certainly in the US and probably in other countries, is more politically sensitive. So maybe there's an expectation that rate will be more managed. Whereas the release valve then becomes the longer end. The 20, 30-year sector is less liquid, less demand. So really, it's the sort of 10s, 30s part of the curve that could really show more of the action, if you like, the steepening, than things like the 5s, 10s and the 2s, 10s.
Simon, are there really any bond vigilantes out there? Dani was talking earlier about a Krugman piece over the weekend, pointing out that, at least in terms of equity investors, no one's really willing to sell off stocks because of perceived risks. They don't want to get outside of the pack, stick their necks out, right? And I imagine that would hold true in bond investing, as well as the fact that you simply need to have these treasury flows for certain businesses like insurance. So is there really the possibility of bond vigilantes driving rates higher?
Yeah, I think it's always a possibility. I mean, 100%, you're right. There'll always be some fundamental demand. But these people, that have this longer term demand, at some points, if they just stay away for a little bit longer from the market to find out kind of what's going on. I mean, this 5% level in the 30-year US is kind of key right now, but there's no reason why that can't be surpassed, right? Because maybe they have been buying at 5%, but then if they suddenly start to get a little bit of cold feet, they start to, pause and want to see what's going on, then obviously we could easily go through that 5% level. So, yeah, I think there is such a thing as vigilantes, but there is such a thing as real demand. But the path between the two can be disrupted from time to time. So there's no reason why yields couldn't just keep going higher if enough people get hesitant about what the fiscal situation is.
And then there's the real question as to how much higher does it need to get to change policy in the trajectory we're on. Simon, thank you so much for joining us this morning. That is Bloomberg macro strategist Simon White. Coming up, speaking of policy, Treasury Secretary Bessent says the president is weighing his options to deal with the country's housing crisis. We're going to get more from Washington, D.C. next. You're watching Bloomberg Open Interest. Treasury Secretary Scott Bessent says the Trump administration may declare a national housing emergency this fall. In an interview with the Washington Examiner, he said, quote, "We're trying to figure out what we can do." Joining us with more is Bloomberg's Washington correspondent Tyler Kendall in Washington, D.C. Tyler, as Matt pointed out at the top of the show, that maybe it means higher deficits as they try to figure out what to do to stimulate the housing sector. What would be their options at this moment?
Yeah, hey, Dani. So in this interview, we really didn't get many specifics from the Treasury Secretary, though he did suggest that the administration is currently studying how it could perhaps standardize local building and zoning codes, as well as cut closing costs for American home buyers. And for context here, President Trump had floated on the campaign trail last year that he would pledge to cut regulations, but also potentially could open up federal land for housing developments. These are the sort of things that could be done through executive action. So perhaps we'll hear about them again as the administration tries to put a little bit more of a finer point on this potential action. Now, I do think that it's worth pointing out here, as the Treasury Secretary says, potentially this could be a national emergency. We have seen the White House before try to use national emergencies to enact policy on a unilateral basis, meaning that they would not need congressional approval. Perhaps the most pressing example at the moment has to do with those tariffs enacted under IEEPA that are currently facing that court challenge. I'll also add that it was interesting to hear the messaging behind this here, Matt and Dani, with the Treasury Secretary really openly pointing to the fact that this is going to be a top issue come the 2026 midterms. It feels like we just got done with an election, but we do know that it is a top issue. In fact, I went back and I looked at our polling right before Election Day. The Bloomberg News Morning Consult polling 2 weeks out showed that 54% of battleground state voters put housing affordability as their top issue.
Well, and it also feels like, Tyler, we just got finished with the business of Congress with the one big, beautiful bill. Was so encompassing. I would have thought maybe it also has some funding in it, but apparently we need more funding by October, and we need a bipartisan bill in order to achieve that without a government shutdown. Is that possible in this Congress?
You're really getting to the heart of the issue, Matt. And I have to say that over the August recess, I spoke to many of the Democratic members of the House that came on balance of power, and almost all of them told us that they are threatening to shut down the government if they're not given some sort of negotiating leverage during these talks, because as far as our understanding is, these bipartisan conversations have yet to start, though that could change in the coming days, because we know that a fire is about to be lit under these lawmakers. Today in Washington marks what we often call Fly-In Day. Congressional lawmakers are returning after almost a months-long hiatus during the August recess. And while they have a month to get to this October 1st deadline, if you actually look at the legislative calendar, they have about 14 working days to come up with a deal. Now, we did get a letter earlier today. It's known as a Dear Colleague letter from Democratic leadership. That includes Chuck Schumer and also Hakeem Jeffries. And they say that they are aligned when it comes to funding the government. What that actually means in practice and whether or not they would go as so far to shut down the government really does remain to be seen. We started to already see these lawmakers message around this while they were home for that August recess. So at this point, it's really up in the air.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall covering everything going on in Washington for us, and there is a lot to cover. Let's get a check on what's going on in markets here. As yields rise, and you can see at the bottom there, the 10-year up to 426, but probably more importantly, the 30-year up to 5. You can see that the pressure on stocks is heavy. S&P 500 falling 1.2%, the NASDAQ falling a little bit more. And it's really these big tech stocks that are all on the bottom.
Well, I'd say it's interesting. We got ISMs and they were weaker, and that seems to at least pared some of the losses in the bond market, but the equity loss, that is sticking. Are we finally getting nerves around big tech and what it means to have them be higher duration assets?
Coming up tomorrow, Victoria Fernandez of Crossmark Global Investment joins us, as well as BlackRock's Gargi Chaudhuri and Empower's CEO Ed Murphy will talk to us about our 401ks. This is Bloomberg Open Interest.